The stock market is a lie. In fact, only a few stocks are responsible for basically all the gains in the S&P 500 this year, painting a picture that things are actually better than they really are, when the truth is, well, the truth is something a bit different. And in this video, I want to discuss that with you, as well as the potential implications for the reality of such a small amount of stocks leading the rallies in the market, and the potential, of course, for what a recession could do to the stock markets. And of course, if stocks go down, guys, Bitcoin, not going to be pretty. Before we get into that, make sure to smash that thumbs up button if, of course, you do appreciate this kind of content, and subscribe to the channel in case you're not subscribed yet, so that you can get more of these great videos fed to you via the algorithm in the future. Let's get it. So these 7 tech stocks, now known as the Magic 7, command almost 90% of the S&P 500 gains this year, signaling the market rally may not actually be so damn healthy. That's pretty interesting. So those stocks, of course, are the big tech boys: Alphabet, aka Google; Apple; Meta, aka Facebook and Instagram; Nvidia; Amazon; Microsoft; Tesla. They gained more than $2.1 trillion in market capitalization year to date. Pretty incredible. Incredibly, those 7 stocks account for 88% of the S&P 500's 2023 gains. That's crazy. Apple's $549 billion in added market cap is by far the greatest of the 7, though each stock is up more than 20%, with more than $175 billion in market cap gains apiece. Yo, that's crazy. That is crazy. In a recent note to client, LPL financial strategist Jeffrey Buckbinder said narrow leadership in the S&P 500 reflects a less healthy rally than one with broader participation. It's all largely being fueled by the AI hype right now. You know, all those big tech companies, right? Everybody's working on the AI stuff. Pointing out there's a lack of technical basis for the recovery as forward-looking metrics for tech remain stretched thin. Mike Wilson, famous bear, Morgan Stanley analyst Mike Wilson noted last week historical data disagrees with the notion that big tech companies are a defensive play, as their gains in recent weeks, as cracks in the U.S. banking system emerged, may suggest, cautioning against investing in the sector until there's a clear bottoming among the broader market. Check this chart out here. So outside of the Magic 7, the performance of the stock market has been pretty muted overall. So while with those top 7 stocks, well, the whole market's been up pretty well. But if you remove those top 7 stocks, market hasn't really done anything this year. It's been pretty quiet for the majority of the companies in the stock market. That's pretty crazy when you think about it. Here's another chart. So excluding the 7 largest stocks, the S&P 500 forward PE doesn't actually look outrageously expensive, assuming that the soft landing narrative will hold. Now, this is an interesting part of that conversation. You see, the mega cap tech stocks, Microsoft, Apple, etc., they right now have a pretty crazy PE ratio. It leads a lot of people saying, oh, the market's just way overheated. Things are a bit too crazy. Those stocks in particular, yes, they are a bit overheated, and they make up huge portions of the index funds and stuff like that, heavy weighting towards these stocks and major funds. However, if you look at the other 493 stocks, actually, their PE ratios aren't that crazy. So this is actually something pretty interesting to note, is that the rest of the stock market not actually feeling as overpriced as some of these tech stocks right now, meaning things could not be as bad as some analysts may suggest. The S&P 500 has added $7.2 trillion in market cap in its rally this year. The top 20 largest stocks accounted for $6.1 trillion of that gain. Again, heavily weighted towards the top 7 stocks. But broadly, again, we're looking at just the creme de la creme at the top here are moving the market, which is pretty damn crazy. So it's not just the top 7, but really the top 20, 30 stocks are where most of the money is going. That we can partially blame some of that on the index funds providers themselves, because a lot of these index funds you invest in will have heavy weighting towards the top of the market. When you buy $500 worth of an S&P 500 index fund, you're not getting $1 of each of those 500 stocks. You're getting like $200 of the top 7 stocks and $300 of the other 493 stocks. Or, maybe a little bit different than that, but approximately that's what you're getting. Now, this is a very interesting chart here as well. The top 5 stocks now reflect 25% of the entire S&P 500's market cap. Now, this is the same exact level seen in 2020 prior to the pandemic-related crash, which is interesting, but I'd like to point out that pandemic crash could not have been foreseen. So even though things were a bit crazy back then, if you think of that reality, 24% of the entire S&P 500's market cap being in just a few different companies, yeah, kind of crazy, but things could have continued okay without the crash having happened. Go back a little farther in history. In 2008, top 5 companies reflected just 14% of the S&P 500's market cap. In 2000, which is widely considered to be the largest bubble of all time, the top 5 stocks reflected 19% of the S&P 500. Markets are being held up by just a few big names, and of course, they're all AI hype-based right now. Of course, we go beyond hype here, right? Obviously, there is a lot of hype around AI right now, but to say that a company like Microsoft or Google is, doing well just on AI hype, they have big businesses, in case you haven't noticed. Apple's big for a reason, and Alphabet's big for a reason, and Meta's big for a reason, because they're big damn companies. Now, before we get into the rest of this story, just a quick note. If you are a cryptocurrency investor, you definitely have to check out the Wealth Mastery Report. This is the best damn newsletter in the cryptocurrency industry. Every single issue jam-packed full of value for you. We have alpha on altcoins and DeFi and NFTs and all kinds of stuff. So if you're investing in this space, you got to check this out. Our team spends about 40 hours every single week putting this together. You can read it in 10 minutes. Jam-packed full of value for you if you're investing in this space. Join our 75,000 weekly readers by using the link down below to get signed up for free. Did I mention it's free? It's free. Check it out. Okay. Next chart here for you. Because of 7 mega caps, the S&P 500 stocks, no one knows this. Since the bull market began in October of last year, thank you, China, for bringing liquidity back into the market, by the way, the average international stock has outperformed the average U.S. stock by a wide margin in nearly every sector. Now, this is super surprising. Super surprising. So we've seen huge gains for international stocks, where we see a lot of fear still in U.S. stocks. So while tech in the U.S., as we've been discussing at great length, has outperformed international stocks, and we've seen communication services outperforming international stocks, what we have seen is that international real estate's outperformed U.S., international healthcare has outperformed, international industrials, international energy, international materials, international utilities, staples for construction, financials, etc. So it's also pretty interesting to understand that there's always opportunity out there in the markets. And right now we have this very, very specific niche rally happening in U.S. markets with just 7 mega caps leading the rally. But there's been other stocks in the U.S. that have performed well, obviously, and international stocks have been surprisingly doing quite well. But still, there are a lot of fears that there will be a massive stock market sell-off still. We discussed in a video the other day, which you may want to go and check out, the reality of, well, when could a crash happen? Well, if we look at when Federal Reserve interest rate hikes pause, historically, we see, and we're expecting one more, which might come in November or December, by the way, but we tend to see in that situation anywhere between 6 and 17 months. The average is around, 12 to 13 months approximately. After that final interest rate hike is paused, right? Final hike, pause happens. Well, then you have a situation where the markets will enter a recession about a year after that. It's not 100% definitive. It's just what has often happened. So if we're still expecting, by the way, so I know seven stocks have gone crazy, right? Rest of the market's stagnating essentially. And if that's the case, well, those 7 stocks are overvalued, the rest of the market's hanging on a cliff, so to speak, and they could come down. There's a lot of fear, a lot of macro fear. What's going to happen with the price of oil? What's going to happen with inflation? What's going to happen with commercial real estate and all this other stuff. There's a lot of stuff that people are worried about markets right now. We've covered all this stuff on the channel. But that does not change the fact that people are worried about this stuff. So if we look at historical benchmarks to consider for recessions, obviously stuff like the Great Depression, we had it all the way down 86%. COVID crash was just a baby, actually, only 35% down. And so on and so forth. The Great Recession, that was 2008, minus 58%. But on average, 50% corrections for the S&P 500 during a recession. That's pretty damn brutal. So you compare that to the current bottom, which settled at 27.5%, which we're quite a bit above at the moment, by the way. If the U.S. is moving towards a recession, then that's only about halfway from what you can expect. For reference, a 50% drop from the all-time high would bring the S&P 500 back down to about 2,400. That's near the lows of the COVID crash. So even if there's a small chance of this kind of scenario playing out, it would have a pretty big impact. So better to be prepared for that possibility rather than ignoring it. And yes, if such a thing were to happen, I mean, hold on to your butts, because that would be nasty, nasty, nasty stuff for the markets to try and absorb if we have a lower price point coming in during a U.S. recession. Look, to be clear, in all previous recessions, the stock markets bottomed during the recession. So let's hope the recession doesn't come anytime soon, and that we have time for stocks and magic internet money and all that fun kind of stuff to have a beautiful big fat rally before an inevitable collapse in a recession, whenever that's going to be. Now, remember, we were talking about Mike Wilson earlier. The S&P 500 looks risky and expensive, he says. Could plunge 25% if something shocks the system. We have lots of stuff that could shock the system. There's 20 different things right now. Massive macro stuff. Bonds and corporate real estate and inflation, et cetera, et cetera, et cetera. They can all shock the system at any time. So he's right to be raising the alarm that, hey, things are risky out there in markets right now, and something could break. We could have a liquidity crisis or some kind of a credit crunch at any point, and that could really throw markets off. So be ready for volatility in the foreseeable future. And obviously, hey, we all hope the market's going to go crazy and keep rallying higher, and they could, without a doubt. But as average consumers keep getting hit with inflation and they're running out of savings and stuff like that, it makes it harder for them to go out and ape into Tesla stocks, for example, or Bitcoin. Though, final thought here for you. I think this is a really, really important one. Long term. We're all talking about short-term stuff. What's going to happen in the next few months, 6 months, maybe a year. Long term, if you just dollar cost average into quote-unquote safer bets in the market, whether that be Bitcoin or Apple stocks or just index funds, for example, you're probably going to be okay. You're probably going to be okay. Long term. Short term, all kinds of chaos can happen in the markets. Be ready. Be careful. Long term, probably going to be okay if we just keep dollar cost averaging in, keep a low time preference, don't get into too much risky, crazy stuff, and you'll be fine. So while the stock market is a lie and the current valuations and the current rally is largely held up by just a few companies, the reality is stocks aren't going anywhere, Bitcoin's not going anywhere. Long term, all this stuff is going to be fine, but be aware that there could be some turbulence ahead. So keep your seatbelts fastened, everybody. We'll see you next time.